Good afternoon, everyone. After the very insightful and thought-provoking sessions by Mr. Ghosh and Shazad in the morning, this session is largely going to focus on the business opportunity, challenges and way forward from amongst the best practitioners from the public market space and the private market space, from a traditional asset manufacturing company, is also amongst the largest wealth managers and advisors in the country today. What we'll do now is, a very detailed sort of introduction to the panelists have been provided, and we'll now look at structuring the session across three themes. One, what is the motivation for investing in India? And it'll be interesting to get insights from all our panelists here. What are the drivers for alternative investing in India, and what's the outlook that each one of them see from the space that they sit in? So to get it started, therefore, if Andrew, if you could draw upon your global experience and what's been your experience in the global asset management companies and the role of India in the overall portfolio of global asset allocator, and especially over the last 5 years, vis-a-vis other emerging economies, how do you see the allocations for India? How has it been shaping up?
Yeah, I mean, this is a question I've been actually asked since 1997. What will FIIs do? Will they be buying the Indian market? Will they, leave the Indian market? If you look over that period, since the market opens in the early 90s, I think FIIs have pumped in some $140 billion now. And in only 2 occasions did they actually become net sellers. That was 2008, which is the financial crisis, and that was about $12 billion, and 2011, a very small amount. So last year we saw $25 billion of net inflows, and this year so far it's $18 billion. So India is very relevant to all asset allocators. Whilst the offshore funds might not be getting any kind of country India focus money, obviously allocations within global emerging markets, within pension funds, are continuing to allocate towards emerging markets. And India within the MSCI is anyway 7-8%. So just for a neutral weighting, you're going to put money towards India. So expect the flows to continue despite what we talk about the markets going up and going down, the political problems we have. So FIIs are here to stay, that's for sure.
Yeah, that's very reassuring. I think in India this year, as far as, so far we've already received about 19 billion worth of inflows. So you don't think, therefore, the noise that gets created on a day-to-day basis here actually interferes with the flows that's been coming through. If I were to now, ask a couple of questions to Navneet, as your experience in as a CIO of SBI Mutual Fund, what's the asset allocation approach of the big institutional investors? And do you see any noticeable difference between the DIIs and the FIIs in terms of their approach towards asset allocation?
Well, yeah, there's a significant difference because in India, if you look at the institutional landscape, so you have insurance companies or provident fund mainly, we don't have large pension funds, so they have a mandated asset allocation pattern and they don't deviate much from that. So there is very little scope for any kind of quantitative or qualitative, I would say, analysis and then deciding on the strategic and tactical allocation and having a proper benchmark where, and then how do you diversify. I think it's mostly given by the statute and they invest in line with the statute. Most of them are buy and hold, very little scope for any kind of alternative investment. Bulk of it goes into fixed income, very little into equity as far as pension funds and all are concerned. If you look at some of the other institutions, I mean, if you term them as institutional investor banks typically come in, I mean, we are talking about the equity, they come in the bull market, they invest in IPOs for short-term trading book gets created. When market falls, that automatically become a long-term investment book. Otherwise, I mean, they are not much active in the market. As far as the corporate treasuries are concerned, from the PSU side, they invest a little bit into the liquid funds and all, but otherwise bulk of the money goes into deposits. I don't know of anyone who invests into the equities or any other alternative assets. From the corporate treasuries, the private sector, some of them take duration risks. A lot of money in last couple of years have gone into duration funds, expecting a fall in interest rates. Of course, in last couple of months, that view has undergone a change. So that's broadly the landscape where I mean, we are looking at institutions globally. Of course, I mean, they have a benchmark. I mean, depending on their investment horizon, depending on their asset liability, depending on their the various other parameters. I think institutions have a proper strategic and tactical allocation in place, and they invest across geographies to diversify across geographies, across asset classes, across investment styles. There is a lot of scope for illiquid investments into that, given the very long-term horizon. Unfortunately, we don't have that yet in India, but I clearly see that at least starting with infrastructure funds and maybe a little bit of some of the other alternative investments, I think from here on we'll see some interest from the domestic institutions into the alternative space going forward.
Great. I think Andrew also mentioned the sort of robust, healthy appetite that FIIs have had in India, and we were discussing during the small break that while the FII flows have been very, very robust, a lot of it has not come to Indian managers in terms of managing that portion of money. What in your mind needs to be done, and does regulation actually have a role to play to ensure that Indian managers sort of get a larger share of pie in that respect?
Yeah, so we've seen in last 5 years, in fact, you mentioned about $18 billion this year, but in last 5 years, $80 billion have come. And if you look at color of that money, bulk of the flows have come from 2 or 3 sources. So one is the GEM funds, the global emerging market funds that have got a lot of money, and they've been significantly overweight on India. They don't like India as much from a macro perspective, but they like the micro story. There are 50, 70, 80 companies which are liked by these funds, and they have been investing into them. Throughout this last 5 years of the volatility, both induced by the political environment, macro environment, they are very comfortable with those companies, and the allocations have been growing. These funds incidentally have done substantially better than not only the benchmark, but because they have been underweight in some of the underperforming markets like China and Brazil and overweight in India, particularly in a segment of the market, they've done very well, and they are getting more money. Can't take the name of those 4 or 5 funds who've got significant money. The second source of money that comes is through ETFs, where people allocating money into India, just put in an ETF. So, and maybe the third source could be the India funds, but I think most of them haven't got much money. So obviously the Indian managers haven't got the mandates or the money to be managed from the global investors. There have been few mandates in last few years, but I think if you look at the amount of money that has come from the global investors and the money which is managed by the traditional Indian managers in that space is very small. But I think over a period of time, as more and more sovereign wealth funds are looking to invest in India. One more point I would like to add, that bulk of the money, as I mentioned, that which has come into India from foreign investors is chasing that top end of the market, those 50, 70, 80 stocks. But as you go down the market cap curve, I'm sure that they would need a local market expertise. India remains the micro level story where the local market nuances, your understanding of being on the ground, your better understanding. And I'm sure that they would look at local managers who can provide that, particularly when they invest into mid and small caps, into the unlisted space.
Great. Now, that was a very useful perspective from Andrew and Navneet on the public market space. And if you were to move away and look at the private market space, Manish, in terms of capital allocation and asset allocation, what are the new trends in PE investing that you're seeing in the private market space, and what's your take on that?
In terms of the new trend, which most of the private equity is kind of experiencing in last few months or couple of years, is we're seeing a lot of young entrepreneurs coming and ready to partner with a private equity fund. Last few months come across some of the instances which were really eye-openers. A young guy of an age maybe around 28, 29, who spent 2 or 3 years working as an ordinary manager in one of the largest commercial bank, it was ICISI Bank, in the back office. Suddenly started, getting into the healthcare business. He got an opportunity, and it was a small setup of taking over one of the center, which was just generating a revenue of few lakhs of rupees. I think in last 4 years, he has managed to create a wealth of around over 100 crore, and managed to get support from a private equity investor who has written a check of $10 million for further scaling up. Similarly, another young guy, aged 30 years, IIT Kharagpur, 3 years back, he decided to quit the family business and started something of his own, and just recently managed to get some private support. Again, he has created a wealth of over 100 crore in the last 3 to 4 years. So the point I'm making is the change we are seeing in last few years is a lot of young, qualified, energetic entrepreneur community, willing to partner private equity community rather than just looking for some kind of a capital available from the family and so on. That's the biggest change we are seeing in terms of the profile. And the second change which we are seeing is the whole shift in the mindset, both between the entrepreneur community and the private equity community, where we have been able to segregate the role of the promoter versus the management, which is true particularly in the mid-market space, which in a way needs a lot of capital support from a private source rather than some of the large companies where they have options of going public and so on, or going to some large institutional investors. So that's the biggest change we are seeing. And in fact, at TVS Capital, we successfully implemented that model with one of our portfolio companies, where initially we just came in as a investor, and in a staged manner, we increased our shareholding, and then there is a kind of a tripartite arrangement between a private equity investor, then there is an independent board functioning there, and the promoter role as a stakeholder in the company is very different from he being the manager of the company and so on through a management contract. So we are seeing that kind of change in mindset both within the entrepreneur community because also the change in the profile of those capital seekers and also with the private equity.
That's a very interesting insight. I think another perspective on the micro story that Navneet spoke about in the public space and the huge role that private equity has had to play as a mature, patient source of capital for the capital-hungry nation that we are. Karan, this is for you, very close to the investors and you amongst the largest investment advisors and asset managers as well, and amongst the early adapters of this space. How do you see the trends of allocations across asset classes? And in terms of clients, what drives the asset allocation decisions across, the various areas?
Well, I think over the last 5 odd years, asset allocation has been fairly simple, to be honest. I think, like Navneet also pointed out, I think close to 70 to 80% of the money has been broadly in fixed income, and 15 to 20% has found its way to equity. Even within fixed income, I think close to 50% of the 75-80% has been in risk-free stroke sovereign papers. Okay. Now, irrespective of the form it comes in, whether the client buys direct tax-free bonds or he enters into an FMP which has got underlying AAA papers, I think at least 40% of his overall portfolio is today in AAA sovereign, where the expectation of returns broadly in the region of 8 to 9% post-tax. The reason for that is simple. I think clients have ended up with large pools of money, and for a certain traction of money, they want to kind of have a safe return. The remaining 30 to 40% of the debt money, I think they're looking at fixed returns, but they're willing to take a slight bit of risk. Okay, so they're willing to go below AAA. For some clients, that definition might be AA minus and above. Some it might be AA plus. For some, it might extend to even below AA minus. Okay, but typically across what we've seen as a trend, I think if we were to look at all the assets we manage as a firm, I think 45 to 50% would be in sovereign debt, 20 odd percent in AA minus to AA plus, and around about 10% in below AA minus debt, which basically is unrated debt. Obviously, that debt would be collateralized, but it would be unrated in that sense. So could mean loan against real estate, loan against shares, and so on and so forth. So typically, if you look at the breakup of debt itself, 50% in absolute safe, 20% in moderately safe, and 10% in slightly risky debt. I think on an aggregate, this ends up giving the client close to around about 9.5 to 10 odd percent in debt returns, which is pretty much what we are also seeking as a portfolio manager over the last 4 to 5 years. Over the remaining 20% in equities, honestly, over the last 5 years, that's been the underperforming part of the portfolio. If you remove the last 4 to 5 months, I think average portfolios have averaged close to around about 5.5, 6% on a compounded basis. So most clients have got 10 odd percent on the fixed income side, 5.5, 6% on the equity side over the last 5 years, thereby taking the average portfolio return to around about 9.25. I think that's what people are expecting a change in over the next 5 years. hopefully with some bit of improvement on the macroeconomic side, some bit of general directional change on the regulatory front, some bit of change on the governance front, and supporting FI flows like both Navneet and Andrew pointed out. Hopefully we can have a market which can give possibly 12 to 15% over the next 5 years. That's what the investors are expecting. And we believe, I think there is a gradual shift of money from equities being around about 15 to 20% to around about 30 to 35% from here on till the elections. So I think that's the gradual shift we expect. So I think instead of being around about 20% of the portfolio, we expect it to move to around about 30 to 35 and effectively possibly be positioned to generate around about 11 to 12% returns as opposed to 9.5, 10 in case broadly the markets do well over the next 4 to 5 years. And in terms of so in terms of asset allocation, I think that's the broad kind of trend. In terms of new kind of pastures, I think we've seen three kinds of clients really. We've seen one is, if I can put it, new generation entrepreneurs or second generation entrepreneurs. A lot of them have been diluting equities in their businesses and effectively ending up with large pools of capital. And given the fact that more often than not, they've not planned out new business ventures, they're typically very adept at sort of planning out a long-term portfolio. And secondly, obviously, is your traditional business houses who've kind of split their large pools of capital into two significant parts. One is the long-term investment portfolio and the other is the broad working capital. And third, and a large emerging class is professionals who've been in their, or more like professional entrepreneurs, so head honchos of private equity firms or large technology CEOs who over the last 15 to 20 years through stock options or otherwise have built in large pools of capital. So these three segments are the broad segments which are ending up with large pools of capital to invest over a long period of time. And on a very generic basis, I think the broad asset allocation is reflected in what I just sort of spoke about.
I agree with you on that, Karan. As a practitioner, that's something that we've seen. Unfortunate as it may sound, but there's been a disproportionate allocation towards fixed income, and that's how most
fortunate in the last 5 years.
Yes. Yeah, and if the rear view, yes, very, very fortunate in the last 5 years, where a lot of pain has been avoided with a lot lower allocation. But the optimism that Karan spoke about and taking a view next 5 years or so, there seems to be a reason for looking at a revised allocation as well. If you were to move into specific to the alternative investments and evaluate what are the drivers of interest in AI, Andrew, this is for you. Mr. Ghosh mentioned in the opening session that the impact of liquidity that has made a significant difference, or the possible impact of liquidity on the flows that have been coming in the AI space as well. So if you were to take it the other way around, what is the assessment, and that's a question that I'm sure gets asked very, very often, what's the assessment of the impact of QE tapering on equities and fixed income, and do you think that will significantly also impact the AI flows the way they stack up? Also, you've launched recently the Ambit Alpha Fund amongst the early adapters in Long Short Fund. What's been the experience? What's been the customer acceptance like, and what do you see as an outlook going forward for that?
So on the those are two very different questions, but
we can break it up. So you can let's first talk about the impact of QE tapering, and maybe then we'll come to the fund that you launched. Okay.
So the QE tapering, I think everyone here will know now that everyone said it's going to be okay, or everyone is saying now it's going to be okay. Emerging markets have had this window of opportunity since September to put that house in order, and the RBI have done what measures they can. So broadly, that's consensus, and I'm not going to try and ride against consensus. But here's where I differ slightly, is that the commentary over the next few days, whether it's this month or next month, will be how quickly tapering will come to an end. And most people, again, are talking about by the end of 2014, and then interest rates in the US starting to increase in 2015, late 2015. But if you look at the US economy, I think the US economy could actually surprise on the upside. Most corporates now are running at capacity constraints. The manufacturing capacity is running at full steam. Productivity gains, they can't make anymore. So my feeling is that corporates, one, will start to invest in their manufacturing, or they will start investing in their people. So you're going to see investment-led growth by corporates in the US. You're going to see wage growth in the US. And this will accelerate the economy a lot quicker than people are thinking. So actually, maybe by the second quarter of next year, we'll actually be thinking about when will the Fed increase interest rates. And I don't think emerging markets are baking that into what they've done today. So there's a lot more work for the RBI and other emerging markets to do. So we could have a scare in the second quarter because I'm not sure that the likes of Turkey, Brazil, South Africa, and Indonesia have done clearly enough. They've done enough maybe for tapering this time around, but not for interest rates rising. And so if the global economy expands a lot quicker, then we'll be talking about interest rate hikes in the US, which could affect emerging markets and flows to emerging markets. And interestingly, whilst everyone's saying tapering is going to be fine, I don't think we've seen any money come back into the bond market from foreign investors. So there's some scare out there still, despite the high yields that you can get from government paper. So I think the market's telling us something in that.
Some bit of reality check still needs to be done. On the long short fund that you launched, and what's been the experience, what's been the customer acceptance around that?
The experience so far has been, it's actually been quite pleasing. I mean, August was a horrible month to go out on the road because, we had tapering, we had problems in our own bond markets, people losing money. But, the whole experience for us has been where we can talk for the first time about making absolute returns rather than relative returns. And I'm not trying to play down my fellows here in terms of mutual funds or PMS, but I think the market's ready for a different type of product, which, you can say, we don't mind if the market's going up or going down or going sideways. Our aim is to make an absolute positive return month after month after month. And I think as that starts to get into the marketplace, I think more and more asset allocators will look towards the alternative investment as they have done offshore. If you think about why as the ETFs work well, it's because they found that some, not all, Indian fund managers not performed offshore. So instead of going into a long-only country fund, they'd said it's easier just to buy an ETF to get the performance. I don't need to work on the manager. So, if people think the markets are going to go up with some volatility, then they can look at a long-short product, to ride them through the kind of shorter-term volatility.
What's been the AUM growth like?
AUM has been quite pleasing. We're adding more distributors, so again that will start to increase. So the returns have been very, very strong as well. So we're very happy.
That's great. I think that's very encouraging for a lot of investors and asset managers in the room. Navneet, this is for you. In terms of what are the top few developments pertaining to mutual funds that were very key to the mutual fund becoming well, it can be debated, the size could have been smaller or larger, but it remains in absolute terms, it is really a very, very large sort of assets that get managed. What is it that industry can pick up and do investor, and how big a role investor education plays in all of this?
That's a very interesting question. So, of course, the industry could have grown a lot more, and I'm sure that in next 10 years probably will be much bigger force to reckon with. But what the AI industry can learn from mutual funds, if I look back last 20 years, what has worked in favor of mutual funds, and if I think of, let's say, 3 or 4 things that comes to mind which have worked in our favor. First would be, and no particular order, I'm just thinking aloud. So one could be, I think, the taxation. I'm not talking of the tax benefit as such, but I think the clarity in terms of from day one, we've been a pass-through. Yeah. So, there has always been absolute clarity in terms of you go to growth option, you hold it for a 1 year, this is the tax, if it's equity, if it is hybrid, if it is arbitrage fund, whatever. There is absolutely always clarity in terms of taxation, dividend tax, everything we have been a pass-through. So, but I think in case of AI, still there are lots of those gray areas, and I think the industry needs to engage a lot more with the authorities and then get that clarity. What else? I think open architecture is something I think in our country where, given the breadth of the market, different kinds of institutions, individual investors, I think from day one we have been an open architecture. We have different kinds of distributors. Banks have been selling all funds. Then you have national distributors, large army of IFAs, And I think that has helped the industry, and probably the AI industry can learn something from that. Something else would be, I think, the performance. And one of the reasons that despite the global trend where the index funds have grown so much, in India still it's the actively managed funds which have been doing far better, because over a longer period, I think by and large industry has done reasonably well, both in the equity side and fixed income side. Fixed income funds, because of the nature of the market, have been managed with an absolute return orientation. One can argue over a period of time probably will move towards benchmark, but has done very well. On the equity side, by and large, across all categories, industry has been able to beat benchmark and has done very well. And that's why I think the index funds haven't grown. So I think performance is very critical. And the another important aspect about the performance is that the way it's got standardized, thanks to maybe regulation and also the competitive nature of the industry and the innovations that have happened in the industry. At 10 o'clock at night, I mean, you go in and see the NAVs of all of the funds. Of course, it can't get replicated completely into an AI structure, but we need to learn that I think that has played a very big role in terms of standardizing. Anybody can go and see how the fund has done against the benchmark. And I think this is one of the reasons that when you talk about the PMS or alternative investments in India, I keep hearing loose remarks, nobody has made any money in real estate here, or people have lost money in PMS big time, PMS hasn't delivered, or those kind of remarks. I think in terms of, globally look at the HFR data and this year macro funds have done this much, long short fund have done this much. I think we need to do something in terms of standardizing and also how to put that performance at an industry level. Maybe one or two, another important thing, I think liquidity is a very important aspect. All said and done, for whatever reasons, investor may not need that money for 20 years. Even if you go to, some of the HNIs that he talked about, they may have cash flows for next 20 years, don't need money, but somehow Indians place a lot more emphasis on the liquidity. And that's why you see that despite all the efforts, people don't put money in 3-5 year FMPs, even if they have money. There's huge premium for that open-ended, the next day liquidity. And our industry in last 20 years, despite the Lehman crisis in 2008, a liquid fund never reneged on its promise. Next day people got the liquidity. Despite the liquidity, at times, both in equity market, in bond market, industry has done very well. And there is a big importance of the liquidity. And I think one of the bigger challenge when you tell people that you have to invest in, let's say, 5-year, 10-year kind of instruments, I think, and it's not that we should move towards, I think the logical thing would be that people look at far more longer term. But I don't know, how do you structure that, or how do you ensure that, and then related point to the education, how do you make investors educated on that particular aspect, and also the regulation, the transparency of the overall industry. I think these are some of the aspects that have played a big role in terms of growth of this industry, and the alternative industry needs to probably look at some of these aspects. On education, one last point, I think that's very critical. And I'm not talking of, at the mass level. Even the elites, the kind of investors that he talked about. I think financial literacy, there is a lot that needs to be there, and it needs to be done. And I think it's a collective responsibility of all of us. So we move from illiteracy to literacy, from literacy to education, and education to enlightenment. But that, I think it's a long, long way to go. And I think all of us needs to work a lot more harder on that aspect. But this, again, I'll repeat that point on the liquidity, the short-term performance, looking at the 1 month, 3 month return of an equity fund. If we have to grow the alternative asset industry, people have to be taught the importance of strategic, and then at least a large part of your portfolio has to be allocated on a strategic basis. And I think the importance of long-term, that if you sacrifice on liquidity, your returns can improve substantially. That aspect needs to be sold a lot more, which our industry has not been able to do that so far.
No, I agree with you on that, Navneet. I think all of us are investors in our own right, and the premium on liquidity that you spoke about rings so well. And I think that's also a trend that's helping develop the public markets or the liquid AI part of it. And some of the challenges hopefully will get addressed because it's still a nascent field. So the maturity and the responsibility and the financial literacy that you spoke about, from and the responsibility that investment advisors, like most of us in the room, have to play, also needs to be stepped up. Tax efficiency remains a very, very important consideration from an investor point of view, and hopefully it will get taken up sooner rather than later in terms of the way regulators end up addressing that. Karan, this is for you. Also because you've had one of the largest fixed income in the AI space, and what's your understanding of the general awareness of the AI amongst the retail clients? And would something like, how big is private equity as an investment category in terms of considerations for the investors?
So I think at the moment, possibly it's not a very, very large portion. So if I was to look at our own book in percentage terms, I think AIF and VCFs put together, because really VCFs is practically like an AIF. I think over the last 3 to 4 years would account for around about 10% of our, or possibly 10 to 15% of our book size, which is kind of reflective of two things. One, of the risk appetite the client is willing to take, and therefore 10 to 15%. And secondly, it has a bit to do with all the problems Navneet mentioned in terms of both liquidity as well as in terms of taxation. So I think both put together, I think in the current time, 10 to 15% is a fair number. The only challenge though has been, it's broadly, the entire 10 to 15% is broadly been on the fixed income side, and more on the fixed income side is on the real estate side. So most of the AIFs which we've collected in large amounts, so out of, let's say, 2,000 crores we have, 1,500 odd crores would be on the real estate side. So as of now, clients have really looked at AIF as more as either private equity or as real estate related collateralized debt. I don't think so investors have yet looked at AIF space as long only equity or as long short equity. I don't think so. These have really kind of built largely in size. I think we do manage long only equity money also under the AIF umbrella, but it's relatively small. It's around about 250 to 300 odd crores. But that is something which I think will develop over the next 3 to 5 years. But needless to say, I don't think so it can develop on a theme of relative return, okay? Because at the end of the day, relative return is something which mutual funds do beautifully. Like pointed out correctly, I think most long only well diversified funds in India have done at least a couple of percentage points better than the index, consistent basis, whether it's 3-year rolling, 5-year rolling, 1-year rolling. So any client looking for a diversified portfolio with a relative return bias is more akin to move to a mutual fund as opposed to come into an AIF. So if I was to look at a breakup of 100 rupees in equity now, I think the core part of the equity portfolio more often than not would end up in the mutual fund side. So I think if you were to look at our own equity allocation out of 100 rupees, I think 50 to 60 rupees would end up in a basket of funds, extremely well diversified, betas much lower than 1, and hopefully returns higher than the relevant index. So 50 to 60% would go up there. 20 to 25%, my gut is, over a period of time would go into AIFs. And AIFs would typically be good independent managers, okay? And that's the most exciting part of the AI business. I think it will encourage independent asset managers with a good track record of 4 to 5 years, whether they've had that track record managing funds overseas coming into India or otherwise. Setting up an AI asset management business is not as cumbersome as setting up a AMC. So it gives them a platform to showcase their fund management skills for a smaller tune of money and with a much more specific strategy in mind. So that 20 to 25% will be consumed by these AIs over a longer period of time, but by managers and by strategies which are much more stock specific. It could be a theme specific strategy, and therefore would need to adjust for factors of taxation, liquidity, as well as fees. All these three would need to be kind of taken into account while allocating that 20 to 25% in equities. And the last 20% in equities, last 15 to 20% in equities, obviously over a period of time will get into a mix of either direct equity for some clients or long short portfolios like Andrew mentioned, where clients are looking at absolute returns. So I think 50 to 60% relative return, 20 to 25% specific customized strategies, and 10 to 15% absolute return kind of strategies is what you'll see the 100 rupee portfolio break into. So I think I'm not seeing mutual funds as an alternate to mutual funds. I think mutual funds will be there for a long time to come and will make up the core part of the portfolio. And you also might see a lot of mutual fund managers and mutual fund houses over a period of year and a half, 2 years get into the AI space also for the non-relative return part. Okay, so essentially for the 20-25% part. if it becomes of size and relevant importance for their overall business. So that's what I see on the equity side. On the debt side, I think given the fees, taxation, lock-ins, you really need to generate a fairly high return for clients to be able to compete with a good FMP giving 9%. So effectively, you need to generate a gross return of close to 18 to 19%, which on a post-tax basis will end up at 12.5, and could possibly compromise, or the client will be willing to sacrifice the liquidity and the transparency and everything for the additional 300 basis points. So at 18 to 19% fixed income, you're really left with not too many options apart from real estate. Yeah, so real estate. So effectively, all put together, I think fixed income in AIF, unfortunately or fortunately right now, is mostly limited to real estate because of the effect of taxation. On the equity side also, I think, again, because of the tax and the liquidity, as of now, I think it will be limited to broadly specific themes and strategies. So I think it addresses around about, in my best estimate, around about 20 to 25% of the clients' asset allocation at the high net worth level.
Okay, Karan, I think that's a very interesting.
Just add some points. But if you look at the, say, the UK, the US markets, you still have a huge mutual fund industry. It's not going away.
Yeah.
Yes.
But you know, the hedge funds have garnered more and more money, not just from individuals, but pension funds going forward. And you know, I mean, for us, we got our license 6 months ago. So we're only 6 months into India knowing about hedge funds or being able to invest in them. You know, we think not just the equity part, but the whole AIF arena will be something like $10 billion in 5 years' time. And that will be a huge you know, incentive for us all to kind of think of new products. And liquidity is going to be key. So for our product, we offer monthly liquidity because of that part of that problem. We want to make sure that investors can move out as quickly as, you know, as a mutual fund if they want to. So it's very important to get the product and the liquidity, and as the, you know, the education of these products continues, I think more and more investors will allocate more and more towards it.
Yeah, but I wish, you know, if you can, as an industry, sort of make some better tax representation. Because obviously in a long-only equity product, if you offer monthly liquidity, you will possibly run the risk of being taxed at marginal rate of taxation. So effectively, those issues still remain. I think for long-short funds or for fixed income funds where the taxation rate is already at marginal rate of taxation, it won't make a difference. But as soon as you go into long-only equity, which would potentially be taxed at zero, post a year, monthly liquidity might be a bit of a challenge.
No, I agree with you. I think the globally $6.5 trillion of US trillion of assets sounds huge, and although you rightly said it's about a year and a half that the AIF regulation and most of the managers actually got into it. But a lot of responsibility is there on the managers, advisors, and clients to ensure that it becomes an industry of scale, and the issues on liquidity and tax efficiency get addressed soon. Now, this is for you, Manish. You know, private equity as an asset class, and you know, Karan did speak about that. A large part of AI now is synonymous with PE and real estate allocations. As a value proposition, what do you see for the clients, and you know, why should they be allocated? It makes imminent sense for the entrepreneurs who are very hungry for capital, and it's been a very patient source of capital for them. But as in, from an investor, from an allocation point of view, what is it that needs to be done better?
No, I think as a good practice, it's good to make opening statement, yes, and agree with some of the views which the other friends have shared. It's an asset class which is relatively long-term, and also an asset class which is relatively illiquid, and therefore the perceived risk around investing in alternate private equity as an asset class is seen to be high. Having said that, also picking up from what Karan said, you know, the theme-based investing is, you know, something which, you know, India will see going forward catching up. I think the value proposition which is available to the HNIs or the ultra HNIs and the family offices is, if you have a pool of wealth to be invested, The question which one needs to ask is, you have options of investing in real estate instruments, you have options of investing in secondary markets, again picking up some of the data which was shared, and we all know what kind of returns some of the secondary market instruments have given to the investors. Then you have options of investing in your own business or doing real estate your own self or getting into mutual fund investing and so on. This is an asset class compared to all the other options available, which is based on relatively high on the fundamentals of the business. You are providing capital for partnering those business rather than investing in equity as an instrument, which you do it typically when you invest in a mutual fund or you are investing directly in a secondary market, where a lot of your fortunes are dependent upon a lot of other market forces, which includes what we are seeing currently based on the FII inflows and so on. So this is an asset class where you give high weightage to fundamental compared to the market forces. Number two, you are investing in businesses rather than investing in equity as an instrument. Number three is, it gives you a platform and opportunity to also partner some of the early stage mid-market businesses. So let me give you an example. If a HNI believes there's a huge opportunity in the education space going forward, and he would like to allocate some of his wealth for education as a sector, and he doesn't want to proactively get involved in managing some of that, what is the option available in the secondary market or investing through mutual funds and so on? Similarly, if a HNI believes he sees a huge opportunity and he's a good understanding of investing in a particular stream of healthcare, the question he is supposed to ask is, what are the options available for him? There are very few large listed companies within the healthcare space, and he doesn't believe in investing in those business models. He believes more investing in the new emerging, some of the business models and so on. So private equity as an asset class, having said that, it is illiquid. Yes. So therefore, if it is illiquid, the question one needs to therefore answer is, what proportion of total wealth one should allocate for an asset class like this? Should it be something like 50% of his wealth? I would say answer is no. But if someone were to allocate 5 to 10% of his surplus wealth in an asset class which is highly liquid, based on fundamentals, and it's relatively long term, where you have aspirations to generate relatively higher return, should someone do that? I think that's a question which, I would suggest, as a wealth management community, we need to kind of debate and take the value proposition to, the family offices or HNIs. So to summarize, it's an asset class where you are partnering the businesses you like. Yes, theme-based investment makes a lot of sense. Then you are very focused. You know what exactly you're doing. And whereas the liquidity part is concerned, I think it's also a perception based on some of the past experience with some of the funds and some of the investments which have been made. Some of the themes which are emerging, and if I have to relate, TVS Capital to those themes, around 70% of our capital allocation is to assets where we can take significant stakes, which includes anywhere between significant minority going up to a majority kind of a number. So therefore, the whole approach in terms of liquidity is to control liquidity event, partner businesses, and then look for strategic exit rather than depending upon some kind of liquidity getting generated through a IPO event, which depends upon a lot of external forces. So you control liquidity in a situation like this. Only around 30% of our capital, we actually invest and being very opportunistic in something like a pre-IPO or a minority kind of investment. So the private equity industry also in India has had learnings in the beginning and have evolved and have come to a relatively more matured stage where I think the liquidity perception is also getting interest.
Fair. No, I think there is, I agree with you, there is a very strong case for PE investments to be a part of the overall asset allocation from an investor portfolio point of view. And that's an interesting dimension that you bring to the table, that way of insulating it against the market forces, not completely, but the possibility of insulating it at times, as also the flexibility of partnering in businesses that you believe in is also an interesting driver that's there. Yeah. Thanks, Manish. And now we'll move on to the third round of discussion. We're largely on the outlook, may not be limited to the outlook specifically on AI, but on markets. And I'm very intrigued to see the first question there, and this is for Navneet. And I'm sure a lot of people, it's been debated to death, but what is your view on the impact of outcome of elections on investor confidence?
There's been an overdose of discussion on politics. In fact, yesterday we released one survey done by the CFA Institute, and in India, very surprisingly, which is not there in any other part of the world, where almost 80% of the people believe that political instability is the single biggest risk for the market. Just 1 or 2 points. I think first of all, markets have never been very good in terms of assessing the impact of a political outcome on the economy and markets. So just to give you a perspective, I mean, 2004, after the NDA lost the election, UPA came into power, markets were almost circuit down because we thought that it's like end of world for India. And next 5 years turned out to be the best period ever in terms of macroeconomic growth as well as for the bull market in the equity market. 2009, we were like circuit up after the UPA too, but then the next 5 years turned out to be very, terrible in terms of the macroeconomy and also from the market perspective. I don't know how would markets react after the May 2014. But just 1 or 2 points, if you look at these state election results, and I think that there are larger forces at play. I mean, there is clearly a silent transformation in India's political economy. I think that we are moving from I would say caste to class politics. I think people are only looking at 2 factors, growth and governance. I think the Raman Singh comes back 3rd time, or let's say Shivraj Singh Chauhan and Narendra Modi comes back 3rd time. It's a very clear indication the way voting percentages have gone up, the polling percentages have gone up, and also the way people are choosing candidates becoming very, very clear. Where also I think not the voters are not liking any kind of populist measures, I think, which is a very strong signal to political class across the board. A lot of people have been fearing that after the election results, state election results, there are going to be more populist measures. I think it's impossible because I think the message has gone very loud and clear that populist measures don't win you votes. I think there is something else that one needs to deliver. Also, I think the focus on inflation, the last 5 years, one of the big problem with our economy, I mean, from a macro perspective, has been persistence of high consumer inflation. And I think inflation has been a very big, I would say, a reason why the party lost in the state elections. And again, the message has gone very loud and clear that I think you need to provide a sustainable growth with a much lower inflation, which in the longer run is very good, both in terms of the risk premium on equity and also from your bond deals. So I'm quite positive whosoever comes into power. I think 97, 98, we had probably the worst kind of coalitions. And India, I think, did amazingly good job in terms of handling economy at that point in time in the face of Asian crisis and the Russian crisis. Also, I think, again, several times, I think, in the coalition politics in last 20 years, we only work when there is a crisis. So we have always reacted pretty well. Otherwise, yeah, there are structural factors that will ensure that we keep growing at 7-8%. So I won't be too perturbed about that. But obviously, if the outcome is in line with what the market is anticipating today, I'm sure there would be a euphoric reaction post-May 2014. Some part of it will come before May 2014. And then bulk of the returns that you are going to get from the next 5 years from the economic and the corporate earnings point of view, I think will get front-loaded in 2014 itself. That has been the history of our market for the last 30 years. And investors must keep that in mind.
No, if you were to pick up the cover page of Economist, which talks about Narendra Modi and the front page, it does give you the salience that politics has, the role that politics has to play in terms of the expectations from investors as well. Andrew, is that something that you'd like to react to as well? Something that I'm sure that's getting asked of you very often now.
Actually, I tried to look beyond the election. So in October, we had to make a presentation to our joint venture partners, Nikko Asset Management, about the outlook for India. So we based it on after the elections, no matter who got in, because even if you had a coalition government, If you look at the facts, because of the crisis, the GDP went from 8% to 4%, but in that time the market only fell by 5%. Yeah. So coalition doesn't, a weak coalition doesn't mean it's really going to be a bad performing market. So the good news is that we think we're going to be in a bull market from the middle of 2014. Now, if that's at the highs or the lows, I'm not sure, and I'll come back to the reasons for that. And we think we're going to be in that period of 2003 to 2006. I'm going to forget 2007, just 2003 to 2006, where GDP growth will start to pick up from 4.5 to 5.5 and then to 7. But the earnings growth, because of the operational financial gearing of Indian companies, will run at a very, very fast rate. It could be anywhere between 15 to 25%. So going back to your returns over the next 3 to 4 years, I think you should be looking at a lot higher, given that the GDP growth will start to pick up, but it'd be really the operational gearing which will push the PEs outside of all the defensive sectors. So again, if you look below the consumer, IT, and pharma, you can pick up most sectors at 11 PE and under. So we're moving very aggressively away from defensives towards cyclicals to take account of what we think is going to happen from the middle of 2014 onwards. In the very short term, though, again, we go back to what's going to happen in the first quarter if tapering happens. And everyone's saying, let me put it differently. When the economy or the markets were going down anywhere in the world, we expected a nice injection of liquidity. And that's what the markets moved up on. And, so tapering or without as much money, where would that money come out from? Which asset bubbles has it caused? If I go around London, I can see it's just booming, and the house prices are booming too. There's something wrong with that. Something will give, and I'm not sure what it's going to be, but something will happen in the first quarter because of tapering, which we weren't expecting, as we weren't expecting markets to go with liquidity where it is. So the first quarter could be a little bit more volatile, and whilst I'm sure we might have, again, the Modi fever in the second quarter, that could coincide with what I was saying before about us talking more about when the Fed might hike interest rates rather than talk about tapering anymore. So it could be a tricky first kind of 6 months. But local politics or the political arena could take us, as we've seen before, to new highs before the election results come out.
There, I'm sure it's reassuring for a lot of us in the room today. On an unrelated note, do you think the government actually has a role to play in terms of boosting investor confidence, and if at all, what is it that can be done?
I think for FIIs, I just want to see consistent policy. So, before I came here, I saw the monetary policy, which I'm now very confused. So I don't think that will go down well with foreign investors. To say, you're targeting inflation at 9%, and if it's running at 11.5%, say I'm on hold, and I look at the next data, it's confusing. I mean, what's the role you're really trying to say to us here? So I think consistency in policy, but I think, for FIIs, since I've been here in '97, I mean, they expect some reforms. They're not expecting big bang reforms. As long as it's continuing to move ahead, I don't think FIIs are saying you've got to do this or you've got to do that. I think if we could attract more foreign direct investment, that would be a much kind of bigger signal for FIIs than whether insurance goes from 24 to 49. That's not a big interest to them. It's just whether it's moving forward. So if the government can kickstart its spending in terms of the infrastructure, that's where you're going to get the kicker in the economy and GDP growth, and then corporate should follow through in terms of their growth as well, in terms of investments. Because if we get to 7% GDP growth and you're not seeing any investment by corporates, you're going to get inflation shooting up again.
Shooting up, yeah. Fair. Manish, in terms of, what is it that you think will drive a lot more of domestic flows to private equity and therefore what needs to be done, or is an expectation beyond the managers that will help make it a more conducive?
I think with a couple of things. One is the numbers, the data we discussed, the domestic capital allocation to this asset class has not been very encouraging. And there's a huge opportunity and potential for the allocation to go up. Recently, we have seen some regulatory initiative being taken on this front where the insurance regulator has permitted insurance companies to invest in the private equity as an asset class. Similarly, we are expecting the pension funds to also start investing in this asset class. So I think the institutional domestic pool available to a private equity asset would certainly go up. I think earlier we also mentioned about, we need a bit of more education whereas the investor community is concerned. I think that's a responsibility which lies with the asset manager and the wealth manager. I think together needs to educate the investor community. I mean, on a lighter note, though we have a very large investor base, sometimes even post-investment we come across instances where people tend to ask a simple question like, I haven't received the annual interest check, those kind of. So certainly, we need to educate the investor community on this proposition. And I think the third is, the liquidity part of it. Again, I think the regulator has taken some initiative in the sense that, they're encouraging the SME listing without going public. So I think that will create, additional platform for private equity to create liquidity for their investment. In addition to that, also recently there has been an announcement by Finance Ministry which talks about unlisted companies from India can go and list overseas without a domestic listing being a precondition to that. I think that would also open a new window for some of the liquidity events for companies who have raised equity from private equity investors. So I think some of these measures would certainly create more confidence with the investor community, and both institutional and the HNI and the family offices. We expect the domestic pool of capital higher allocation going forward. And what is also interesting is it is not just the domestic asset managers which are looking for tapping into the domestic pool of capital. Recently, we have come across instances where even some of the foreign asset managers like KKR have gone and raised domestic capital in India to invest. So I think it's an interesting time. I think next few years we should see a lot more domestic capital flowing.
Great. I just realized that we got so involved in the discussion that we've been reminded that we've already eaten up 15 minutes of lunchtime for everyone. So this is the last one for you, Karan. We've discussed a lot in terms of what needs to be done for AI to become a lot more relevant to the retail investors as well. Is there anything else that you would like in that space in terms of something that hasn't been discussed as yet and you think needs to be brought
I think we made an important point on standardization of performance and availability of information. I think that is critical. There are clauses within AIF which allow the AIF units to be listed. The NAVs, I think all AIF managers should be encouraged to disclose on a weekly, if not a daily basis. Obviously, within private equity it's not possible, but in most other things it's possible. So though the liquidity and resale of units might remain a very, very privately driven market, yet I think the listing, the information being available on mediums like Bloomberg, categorizations in the right buckets will give the industry a big impetus. And I think in general, today if somebody was to ask me what's the size of the AIF industry in India, I would be struggling for an accurate number. If somebody was to ask me for the track record or performance of the 5 or 6 funds which have been launched, I think we would be struggling for a performance number. I think whereas for mutual funds that is easily available off the shelf. I think at some level, though we are constrained with liquidity and the bid-ask spread in some of these being fairly high, I think we still need to encourage a common platform for reporting performances and giving the breakup of the portfolios and the composition of the portfolios. I think that will go a long way in reassuring not only retail investors and also institutional investors. And we'll see many more institutions do a greater amount of analytical research on these instruments, and therefore I think that will give a big boost to the overall industry. And I think that's where other modes of distribution will also come in, whether it's IFAs or it's other distributors. Everybody will be encouraged only to look at these once the knowledge is there. Okay, so I think we need to take lots of steps to kind of list it and empower people with the knowledge of what possibly we have.
Yeah, I think as industry matures, a lot of these issues should get addressed. A lot of responsibility that we need to take, that it gets addressed the soonest. Thank you so much, gentlemen, for your very interesting insights, and I'm sure everyone has enjoyed the discussion. And let's break for lunch now. Yeah? Thank you.
Just a moment, can I have your attention, please? I'd like to just request Mr. Aditya Gadke and Mr. Srinivas Jain from SBI Mutual Fund to kindly step onto the dais and felicitate our speakers. Thank you, panelists. Thank you, Ms. Arpita. Request you to please come onto the stage for a group photograph. We've placed a board right next to the stage. Would request our speakers to kindly give us a small remark there. We've placed it there. All right, ladies and gentlemen, we now break for lunch. Let's resume after the sumptuous lunch we've arranged for you. Thank you so much.